This week's changing of the guard at the Federal Reserve sees Ben Bernanke bow out as chairman of the Board of Governors after a difficult tenure during which the world's biggest economy was buffeted by a series of crises. He had to mastermind the US Central Bank's response to the tumultuous events, including the subprime mortgage horror and housing price bubble which triggered a financial crisis and the collapse or near collapse of major financial institutions. That led to what's been called the gravest economic crisis since the 1930s, with a recession affecting millions of Americans. The Fed's response was an unprecedented program of massive bond purchases known officially as quantitative easing to pump stimulus money into the US economy. Those large-scale asset purchases mean the Fed's balance sheet has risen from $800 billion before the financial crisis struck to $4 trillion last year, heading for $4.5 trillion. Shrinking that and winding down the stimulus while boosting growth are the tasks facing Janet Yellen, a highly respected Yale-trained economist and the first woman ever to chair the Federal Reserve. BNP Paribas senior economist Alexandra Estio told Euronews she also has to head off deflation. The challenge for Janet Yellen is to make inflation rise because right now it's too low and it's not moving. She also has to ensure that the unemployment rate continues to fall, but to fall for the right reasons and not because unemployed people get discouraged and give up looking for work so that they are not recorded in the statistics. Like Bernanke, Yellen is very much focused on jobs. She said economic policy should be about caring for real people and creating jobs. The US unemployment rate did drop to 6.7% of the workforce in December. That's the lowest since October 2008, but it is down partly because of those discouraged workers giving up hope of finding a job.